Okay, so chapter 9. Here we are going to deal with, move that out of the way. Could move it somewhere else. Okay. So here we are dealing with long-term assets. So chapter 8 dealt with current assets. So now chapter 9, we're getting into long-term assets. So long-term assets are just any assets that we use for more than the current period. So, here you're looking at equipment, land, long-term notes receivable. So anything that we're going to be using for longer than just the current year. So, current assets are like cash, accounts receivable, supplies, your prepaids like insurance and rent, all of those things that we consume in the current period. So now we're going to switch over and talk about long-term assets. And we talked briefly about some of this in college accounting. We dealt with learning a little bit about how to account for depreciation. You remember that? Like when we have these long-term assets that we're using for more than 1 year, we need to cost them over the life of that asset. So in college accounting procedures, though, all we learned as far as depreciation was they gave you an amount and you did the adjusting entry, where you debited depreciation expense and credited accumulated depreciation. So in this chapter, we are actually going to learn how to calculate depreciation using a couple different methods, and talk more about like accounting for land and things of that nature. So long-term assets are also known as fixed assets, okay? So these are permanent assets. So we keep them, they're tangible is another word, so you can actually physically touch them. So you're talking about things that you're keeping, again, for more than 1 year. So it could be equipment, machinery, buildings, land, anything that we're keeping long-term in the business. So long-term assets, basically the whole idea is we keep them for several years, so we need to expense them out over the years that we use them because they're helping us earn revenue the whole time that we have them, hopefully. Again, there's lots of different terms for fixed assets. You could have them called plant assets, or property, plant, and equipment, or again, long-term assets. They can't just decide on one name. They give us 5, but they all mean the same thing. So fixed assets, plant assets, property, plant, equipment, okay? So I kind of already talked about this, but they have the following characteristics. They exist physically, so they're known as tangible assets, okay? They are owned and used by the company in normal operations, and they are not offered by sale as part of normal operations. So we're keeping them and utilizing them to help us earn revenue. Okay. On the other side of that, when we're dealing with costing something, cost is something that has been incurred. So that could be purchasing a fixed asset or purchasing an investment or just an expense like rent or utilities or something like that, okay? So when we're looking at evaluating the cost of something, we need to look at how we're utilizing that. What are we purchasing? Well, if it's long-lived, so then it's a long-term asset, then it needs to be recorded as a long-term asset. So it's either a fixed asset, land, equipment, vehicles, that sort of thing, or an investment, okay? If it's not a long-lived item, if it's like utilities or supplies or something like that, then it's an expense, okay? Step 2, is it used in normal operations? If it is, such as land or equipment or something like that, then it will be recorded as a fixed asset. If it's not used in normal operations, then it's going to be recorded as an investment. We're not going to deal with that side of things right now, really, but here we're looking at if we made some long-term investment, okay? But we're really going to focus first on the fixed asset side of things. I already talked about that. So the first thing we want to talk about, though, is how we determine the cost of these fixed assets. So the cost is always the purchase price plus any price it takes to get it ready for use, okay? So we kind of looked at this very briefly in college accounting as far as land goes. When you acquire land, you always put the cost of your asset on your books as the price you paid, okay? So we know land, the value and what you pay could be two different things, right? Like, you know, when you go to buy a home or when you go to buy land, the price you pay may not be the same as what it's valued, okay? That's okay. In accounting, we always deal with the price we paid. So that's what we're logging. We're not logging what the land is actually worth, just what we paid. Same for buildings, machinery and equipment, anything. You know, we can pay less than what it's valued at, or we can pay more, depending on, you know, the market and how badly we want it. We're going to always record the cost of fixed assets at the purchase price. And then any other costs that are associated with getting it ready for use. So to give you some examples, well, if you buy a building, you know, if it's already a standing building on land that you're also purchasing, you know, a lot of times you purchase land with the building, then there may be some fees or some costs associated with getting that building ready for use. You know, very rarely could you just move right in and resume operations. So there could be architect fees, engineering fees, insurance costs, interest because we had to borrow money during construction to finance construction, sales taxes. We usually pay sales taxes when we acquire fixed assets. And then you get into other things, repairs. So maybe we purchase an existing building and it needs some work. So that's a cost of that building. Reconditioning, modifying it. We need to modify it to fit our needs. And then any permits, you know, any type of permits we need to do those repairs and modifications. So all of the costs that it takes to get that building ready for us to use for operations is the cost that goes into that building. Machinery and equipment is kind of the same thing. You could have sales tax, you could have freight, you know, to have it shipped to you. You could have an installation charge. You could again have repairs or reconditioning if we were purchasing used. You could have insurance, assembly, and then even modifying for use or testing for use, and then again permits. So anything to get that machinery and equipment up and running where we actually are earning profit. Okay, so those are all the costs associated with machinery and equipment. And then the same goes for land. Land, you'll have your purchase price that you pay, and then you'll have sales taxes, again, any permits. You could have like broker's commissions, you know, if you paid a real estate agent, title fees, surveying fees, delinquent real estate taxes, hopefully not, and removing any unwanted buildings. So if there's buildings on the land that we don't want and we have to clear them off, then we consider that a cost of the land, as well as grading and leveling. So anything to get the land ready, okay? So if we have to do any grading or leveling. So those are all considered land costs. And then land improvements is when you're putting in items that improve the functionality of the land. We're not going to include those in the price of the land. So when we add a parking lot or lighting or landscaping, all of those are considered their own land improvement account. And the reason for that is they're going to depreciate on their own, right? Does land depreciate?
No.
No. So land never depreciates, right? If anything, hopefully it goes up in value because it's a finite resource. But those land improvements, do we put a parking lot down once and then it's good for life?
No.
No, we wish, right? But, you know, parking lots get holes in them and cracks and they need to be resurfaced and redone. So land stays as it's its own asset, and then those land improvements get logged separately because we're probably going to have to replace trees, you know, or sod, parking lots for sure, lights, you know, all of those things depreciate and need to be replaced over time. So that's kind of why we keep those costs separated, okay? So sometimes it's a little tricky, you know, it's like, oh, is it a land cost or is it a land improvement? So I always just think, with the land cost, it's the cost to get it just prepared to do whatever we're doing with the land. You know, it doesn't include like putting a new building on it, that's a building cost, but to get it graded and leveled and ready, okay? We're not going to go into this, but you can kind of see, you won't have to know it. But we do sometimes incur additional costs that aren't included in the cost of the asset. So if it's an unnecessary cost, and we're just going to expense it out. So if there's vandalism or some type of mistake made, uninsured theft, damage, fines for not getting the proper permits on time, any of those costs are what we would consider abnormal costs, and we're not going to put those in the cost of the asset. Okay? We don't want to increase the value of that asset beyond its actual value. So those are all just expensed out. And hopefully we don't run into those or very many of them. But if we do, we'll just expense them out. So to illustrate that, Kimball Incorporated purchased equipment for $12,000. We had freight of $600 to transport it. And then installation cost $1,500. And that included $500 due to an error in installation. So to record that journal entry, again, equipment is going to be charged for the full price to get that equipment up and running. So we have the price we paid at $1,250 plus the $600 freight plus the $1,500 of installation, but we subtract out that error in installation. Yes, sir.
Why did the freight costs not separated compared to what we did with the accounting procedures where we had like the freight
cost, like a freight expense?
Yeah, the freight expense.
The reason for that is we consider it part of that asset cost. So when we're dealing with assets, we include freight as part of the cost of the asset because we want to add up. Basically, the idea of costing an asset is to add up all the costs associated with getting it working, and then we're going to spread that cost over the life of the asset using depreciation. So it will get expensed out, but it'll just get spread out over time.
So why are you subtracting $500? Why wouldn't you just not include it at all?
You could say $1,250 plus $600 plus $1,000. You're just taking the total installation cost.
Oh, okay, it says including. Okay.
Yeah.
Because that was a part of the.
Yeah, the $500 was included in the full installation cost.
Like
no, yeah, it was $1,500 total, so they're showing it coming out. Yeah. So that equipment, we add up all those costs, and that's the cost that we debit to the asset equipment. Okay, and then we paid cash in this case. Okay. Any questions on that? Okay. We're not going to worry about that. Did you have a question?
Yeah, I was wondering why is that $22,000 because I'm not clear for the labor.
Well, you add in the $1,500 for the installation, but there was an error of $500 that we subtract out. Yeah, so $500 was an error, and so we don't put that on the cost of the asset. We're not worried about that. We're not worried about leasing. Okay, so again, part of the meat of this chapter is dealing with depreciation. So again, we kind of hit on that in college accounting, where depreciation, again, is just spreading the cost of the asset over the life of the asset. So, we're looking at the total cost for land, machinery, equipment. If we're going to use that equipment for 5 years and it's going to help us earn a profit, we want to match our expenses to that profit, right? That's the matching principle. So we're taking the cost of that equipment and just spreading it out over the 5 years that we're using it to help us earn profits. That's the whole idea of depreciation, is just taking that expense and spreading it over the life of the asset. And so we do that through depreciation. Now, again, land has a limited life. It doesn't decline in value generally, so it is not depreciated. So when we purchase land, it stays on our books as an asset until we sell it or otherwise dispose of it, usually sell it. But any other fixed asset, machinery and equipment, vehicles, anything like that, buildings, land improvements, those all get depreciated over their useful life. One thing we really didn't go into in college accounting is we just dealt with spreading, the cost out over its useful life. So we know we have physical depreciation, when you buy equipment or a vehicle or a building, over time it just declines from wear and tear, okay? But we can also have what we call functional depreciation. So this is when, usually more with equipment, machinery, where we have machinery and it's great, it works great for the first few years, but then technology changes, right? And we see this a lot in our present day. And so that equipment may become obsolete, or we may have better equipment to replace it before it actually breaks down and is no longer useful. So sometimes we replace things because of basically technology and not because they're done, being productive. There just is something more productive out there and more cost efficient usually. So one thing that people confuse with depreciation is they think depreciation is actually the decline in the actual value of the asset. It's really just our way of costing the asset out. When we look at book value, which is the cost we paid minus any depreciation, that's our book value. That doesn't mean it's the actual value of the asset. That's just the value on our books, okay? So it depends on how we use depreciation, how quickly we depreciate something, but the actual value can be higher or lower, okay? And depreciation does not provide cash to replace fixed assets as they wear out. Again, the whole idea of depreciation is just spreading the cost over the life of the asset. So that doesn't mean we're getting any money out of it or what its true value or true worth is. It's just our way of accounting for that cost, okay? So when we're calculating depreciation, we need to know a few things. Well, we need to know the initial cost, which we talked about, how do we calculate cost? So we've done that. We need to know its estimated expected useful life, okay? So again, useful life is just the amount of time we think we'll use it. And it's an estimate, we're now in financial accounting. We've already dealt with that with accounts receivable. We're dealing with estimates now and not finite amounts. So we can do this based on, the historical information on that, piece of machinery, or maybe we've had that same piece of machinery and we're just upgrading or replacing it. So we kind of get a good guess or a good estimate on how long it's going to be useful. And then we also need to estimate what's called the residual value. Residual value is just what it's worth when we're finished with it. And, it can be a varying amount. Like, think of vehicles. You buy a vehicle, right? You could buy a new vehicle or you could buy a used vehicle. How long do you typically drive a car before you replace it?
10 years.
10 years till it breaks down? Do what till you're ready to upgrade, right? So it depends, right? Yeah, so everyone kind of has their own idea of when you replace that, right? Some people say till it no longer functions, I have to buy a new one, or 10 years or 5 years. It depends, right? It depends on a lot of factors. Like last time I bought a car, I planned on driving it till it broke down, and then I, got married and added another child into my family, and my little Chevy Equinox was not cut out for a family of 5. So, I now drive a minivan. Woo-hoo. So, I love that thing, by the way. I'm not ashamed. So, there's nothing better than sliding doors when you have kids that open doors and dink cars all the time. Sliding doors are the best. Anyway, so, that was more of a functional depreciation situation for me. That my Equinox was no longer functional, and my husband has a mid-sized sedan, so that was also not functional. So he got to keep his sedan, but I changed because it was a need, and we'll see that in businesses too. So sometimes they're going to keep assets until they die, or for 5 to 10 years, and sometimes they're going to need to be replaced because there's a need. So that residual value can be different in different situations, right? My residual value on my Equinox, well, my Equinox was 3 years old, so it still had a good value to it because, I hadn't driven it. I'd bought it brand new and then driven it for 3 years.
This is a true story.
It is a true story, yes. I can't make this stuff up, right? So mine had a higher residual value because, again, I replaced it for a different need. I needed to upgrade. Well, we figured we needed. Trust me, when you have 3 kids all on the same row together and they're all getting bigger and they're yelling and fighting, it was a need. So, but, you know, the minivan is probably going to get driven into the ground. So it will probably have a very small, if any, residual value left. And again, this can be estimated based on how long I intend to use it. And then, you know, like with vehicles, you can get on like Kelley Blue Book and kind of estimate the value. Of course, I don't know how many miles, but I can estimate, right? I know typically how many miles I drive a year, so I can estimate. I know it's going to get a little banged up because I like curbs. And I park in a college parking lot, you know, it's like between the two, it's just going to happen. It actually looks good still right now. It's a year old. Well, it's 2 years old, but I've had it for a year.
Where's it at?
Right? Yeah, I'm like, no, it still looks good right now. I haven't hit anything except for when it has the automatic back hatch. And it's so much bigger than my Equinox, like it hits the garage door when it goes up. So that it's got a little scratch on it, but you know, that can be buffed out. It's not a big deal. Got to get the groceries out. So anyway, the residual value is going to be an estimate, but we can generally do a pretty decent estimate. So those are the three numbers we need in order to calculate the depreciation, or you know, how much we're going to expense it every month or every year. And we kind of already talked about that. We talked about that. Just so you know, residual value might be referred to as scrap or salvage value, or even trade-in value. So again, those terms all mean the same thing, depending on, you know, different companies refer to it a different way. So basically what we need to calculate first is what's called usually the depreciable cost. So we take our cost that we paid and we subtract out the residual value, okay? So depreciable cost is just the assets cost minus the residual value, because that's how much we need to expense out over time. The residual value is what we think we'll receive for it when we're done with it, right? So we're actually going to hopefully receive some cash in some cases when we're finished. If it has no residual value, which could be the case, then the entire cost will be depreciated over time. Okay. So let's look at an example. In this case, we have Exeter Company purchased a new forklift on January 1st. It had an initial cost of $24,000, and again, that cost includes the purchase price plus any freight or insurance or anything to get that forklift ready to use. We expect to use it for 5 years. And at the end of 5 years, we estimate that its residual value is $2,000. Okay, so $24,000 or equipment forklift. We're going to use it for 5 years. At the end of 5 years, we think it's going to be worth $2,000. So basically, what we want to do is we're going to take cost minus residual value to get how much we're going to depreciate. So that's the expense. The depreciable cost is the full expense of owning this forklift, or our estimated.
Divide that by 5.
Do it.
Each year. Divide that by 5 each year.
You will in straight line depreciation. Yeah, it's a good question. So we have different methods of calculating depreciation, and one of them is just to spread the depreciation expense equally over the whole life. And in that case, yes, super easy, right?
Yeah.
We like that method. So in this case, our full depreciable cost is $22,000. And yeah, we're just going to take that $22,000 and spread it over the 5 years of useful life. So we're going to expense out part of it every year. Okay. Again, it depends on what depreciation method we use, and there's reasons we might use different ones. So it could be an even amount every year, the same amount every year, or it could be greater and then go down smaller. We'll kind of look at that. So we're going to learn 3 methods of depreciation. We have straight line depreciation, units of activity, and double declining balance. There's other ones. There's sum of the years, digits, and there's, well, we'll just stay with those. We aren't going to learn. We'll just learn those 3. Okay. So the big takeaway here is that a company has to choose a depreciation method and stick with it. So they can't use straight line 1 year and then go to double declining balance and then switch back. Part of that goes back to our accounting principles. Everything needs to be comparable. So if we use one method 1 year and then switch to another, they're not going to be comparable, okay? So companies choose a method for depreciation for all of their assets, and they stick with it. So like I was saying, straight line method is just going to be the same expense every year over the useful life. So it's the easiest method. So when we're calculating straight line depreciation, the formula for the annual depreciation, so 1 year's worth of depreciation, we take cost minus residual value to get that depreciable cost, and we divide by the useful life in years. So we already had the depreciable cost, right, the 22,000, cost of 24,000 minus 2,000. So our depreciable cost was 22,000. We divide by 5 useful life years. So every year we would depreciate this forklift $4,400. Okay. And there it's showing you all the years. The straight line rate, that's just the rate at which the item or the forklift is depreciating. It's always just 100% divided by the useful life in years. That's where they're getting that 20%. So they took 100%, divided it by 5. So we're depreciating this forklift 20% every year. Okay. And then, of course, it'll be depreciated, the full depreciable cost over time. Now, of course, this is a very fairy tale situation, you know, where we purchased this forklift on January 1st and we've used it the whole year, you know, because we have full years of depreciation calculated here. Okay. The only time straight line gets a little bit confusing is if we purchased that, say, in March, we've had it for like 9 months or 10 months or whatnot, depending on when we purchased it in March. We don't want to depreciate it a full year if we've only had it like 9 months out of the year. Okay. But we'll get into that later. We talked about that. So to record each year's depreciation, it's an adjusting entry, like we learned in college accounting procedures. So we debit depreciation expense on the forklift, and we credit accumulated depreciation on the forklift for 1 year's worth of depreciation. This is at the end of the year, so we've had it the whole year.
Is accumulated depreciation a credit account?
It is a contra asset account. So it will be a credit account. Mm-hmm. So yeah, accumulated depreciation, if you remember from college accounting, the thing with assets is we always want to keep them on the books at their original price that we paid. So forklift's an asset, so it increases on the debit side. What was it, 24,000, right? So we bought that and we debited it 24,000. When we recognize depreciation, we're going to put it in that accumulated depreciation account. So accumulated depreciation is a contra asset account, so it increases on the credit or the opposite side of an asset. So every year we'll depreciate that, and we'll put it as a credit into accumulated depreciation. So it is affecting the forklift, the value, you know, our book value is what it's called. So book value is going to be equal to that forklift, the cost, minus any accumulated depreciation. So in this case, after year 1, so this is at the end of year 1, we had a cost of 24,000 minus depreciation of 4,400. So our book value at the end of year 1 is 19,600. Okay. So that's the amount that we haven't costed out yet. Okay. That's the book value. So book value is always just cost minus accumulated depreciation. So then after year 2, we would subtract another 4,400 to get the new book value. Okay.
So you just do the residual asset just to be able to get the 4,400 and then just keep subtracting it out?
Yes. Yeah. So the residual value is only important really in calculating that depreciation. And then when we actually get rid of the asset is when we'll deal with that residual value. Good question. Any questions so far? All right. Okay, we covered that. See, I just got ahead of myself. So the book value or net book value. So this amount here, this book value, is what would be listed as on our assets. You know, on our balance sheet under long-term assets, you would actually see the forklift minus that accumulated depreciation. So the book value is what we report on the balance sheet as our asset because that's how we have it currently valued. Again, the forklift could be worth more or less than that in, you know, the real world at that point. That's just how much we have it. The book, that's just our book, you know, what's on our books. Okay. So yeah, on the balance sheet, we would see equipment minus accumulated depreciation. So the book value would be listed as the assets value. Okay. So those are important concepts when we're dealing with depreciation. Probably some of the biggest, just to understand depreciable cost and book value will make it really pretty easy to calculate depreciation. So here it's just showing you, you know, depreciation expense is the same every year for 5 years, and the book value continues to decrease until in year 5 we've depreciated all the depreciable cost, and notice we're just left with that residual value of 2,000. Okay. So again, this is an ideal situation where we put it in play the first day of the year. We've used it for 5 years total, December 31st, and now we're like, we're getting rid of it. It still has $2,000 of value. Okay, so that's kind of what it looks like using straight line depreciation. So straight line depreciation results in the same amount being depreciated every year. The next method is what we call units of activity method. So you still start with your depreciable cost. So we're still taking cost minus the residual value. But now maybe it's equipment that's making something, you know, some type of machinery. So not a forklift that we're using, but we could depreciate a forklift based on units of activity as well. But say we have some type of machinery that produces something, you know. So we can depreciate machinery based on how much it's outputting, okay, or its units of activity. Okay, it may be called units of production. So the first thing we calculate, it's actually a two-stepper, but it's still pretty easy. It's pretty similar to straight line, really. It's just the first step is you're going to calculate what we call depreciation per unit. So with units of activity, we have to think about, okay, we have this piece of machinery. Instead of how many years it's going to last, we're going to look at it as its expected life in units of output. So we think this piece of machinery over its life can produce 50,000 pens or whatever it's doing, okay? So what we do first with it is we calculate depreciation per unit. We'll notice it's pretty similar to straight line, right? Cost minus residual value to get that depreciable cost. Instead of dividing by useful life in years, we're dividing by total estimated units of activity. Okay, so it just has a new useful life. Instead of useful life in years, with units of activity, we look for how many units of activity is this machinery going to be capable of producing. So we calculate depreciation per unit, And then each year, we just look at, well, how many units did this machinery produce? And then we take depreciation per unit times the actual activity. Okay. So in year 1, we made 10,000 pens. We would take depreciation per unit times 10,000. So the benefits of this is it's a little more accurate, right? You're not just spreading the cost evenly over 5 years. Because we know with machinery, the first year I may use it really heavily. Maybe the second year I use it really heavily. Maybe year 3 I get a second machine, and so I'm not producing as much. Or maybe sometime in year 3 it breaks down and it's out of commission for 2 months. So units of activity is good for like machinery and things like that. It'll more accurately line up the cost with the revenues, okay, that machinery is helping earn. So in this case, we have our forklift still. We'll still look at the forklift here. It costs $24,000, residual value of $2,000. It's estimated to have a useful life of 10,000 operating hours. Okay, so we think we'll get 10,000 total hours out of this forklift. So we can use units of activity instead of the straight line method. During the first year, it actually was used 2,100 hours. So again, we calculate depreciation per hour or unit. So cost minus residual, 22,000, divided by the total estimated units of activity of 10,000 hours. So basically, this forklift is costing us $2.20 per hour of use. Okay, so that's depreciation per hour. First year, we used it for 2,100 hours. So 2,100 hours times $2.20. So in the first year, we're going to recognize depreciation of $4,620. Okay, so with units of activity, it could be different every year.
So that second one is just for that first year?
Yes.
Second.
Yeah, step 2 is just calculating depreciation in the first
It's a
year.
year, the amount of hours or whatever.
Yeah, but that's correct. It would be the first year.
Okay, there.
And then next year, we would look at how many hours we used it. Your $2.20 per hour stays the same once you calculate it. So you would just like maybe next year we used it 2,500 hours. So we take 220 times 2,500 hours. Yeah. So yeah, that's just year 1's depreciation. And then we would calculate the remaining 4 years. Your journal entry is the same. I mean, the amount changes, but you're still debiting depreciation expense and crediting accumulated depreciation.
So it was something like this, you would do this at like the end of the year?
Yes, yeah, depreciation is always done at adjustment time, so the end of the year. So it's an adjustment. In this case, our end of year is December 31st. So yeah, good question. Always done as an adjustment at the end of the year. But your journal entry is the same. Debit depreciation expense, credit accumulated depreciation. Okay, just the amount changes. How we're getting that value is what's changing. And here they're showing us all 5 years. So year 2 used it 1,500 hours. Again, maybe it was broken part of the time or we had some other machinery. Year 3 it was used really heavily, and then year 4 and year 5.
So those differs in every year.
Do it.
So it differs every year.
Yes, yeah, with units of activity, you're going to have a different amount of activity, so a different depreciation every year. But it should add up to the total of 10,000 hours. Again, in a perfect world, right? Because that's where we live. It always adds up. Okay. So units of activity is just a little different. It's still pretty easy, though. So here it's just showing you, and it's a little smaller, but it's showing you, we have different amounts, of course, of depreciation year after year. So it changes over time. But your depreciable cost, the full amount you're depreciating, is the same. You're still depreciating $22,000 over 5 years. It's just different amounts. Okay? And that's showing the book value again. The book value is always going to decline. This one's just declining at a little less of a linear way because it's not even. In year 3 we had a bigger jump in depreciation expense, for example. So just a little different. But again, over 5 years, we're still depreciated at $22,000. So at the end of year 5, it still just has that residual value of $2,000, which is our goal. The last method is probably the trickiest method. It's just a little different. It's called double declining balance method. So what it does is actually uses an accelerated form of depreciation. So we take more expense in the first couple of years, like double basically almost. And there are some reasons for doing that. You're going to see, if you ever work in accounting, a lot of companies will use an accelerated method of depreciation on their taxes called MAKERS, and it's legal, just so you know. So there's a formula for calculating this, and you expense it off faster, so that cost gets off your books faster. So it reduces your tax liability a little bit in the first couple of years because you have a higher expense, which people always like for tax purposes. And then in theory, it's freeing up that money to kind of invest in new assets. So sometimes people use accelerated methods of depreciation because you cost it off of your books faster. So you're recognizing that expense faster and getting it off your books. And then it kind of frees up money to go buy new assets, okay? Again, it also lowers your tax liability in those first couple of years. And some people like it just because if you're expensing off more of the price in the first couple of years, when generally that whatever it is, especially machinery and equipment, is working better, you're probably earning better revenue. It's helping you produce higher revenues in the first couple of years. So you might as well expense some of that out in the first couple of years. Because once we get into year 4, 5, 6 of that equipment, it's probably not helping you earn as much in revenues. And you might have other expenses, repairs, maintenance, things like that. So that's just a couple of reasons why people might choose to use an accelerated method. Oh, I went through the steps. So with double declining method, as you see, there's 3 steps. It's just a little different. We don't actually deal with depreciable cost. So I think that's probably the most confusing to students because the other 2 methods, you're taking cost minus the residual value. So a double declining method, you start with determining the straight line percentage, okay, using the expected useful life. So that's just always 100% divided by the useful life. That step's pretty easy. So step 1, we take 100% divided by the useful life in years to get the straight line percentage. Step 2, we take that percentage from step 1 and we multiply it by 2. We truly double it. That's pretty easy, right? So if you get 20% here, step 2, it becomes 40%. Okay? That's how much we're going to depreciate it every year. It's pretty high, right? Again, it's double the straight line. And then step 3, we take the book value, so the book value of the asset, and multiply it by that percentage. Okay. So how this works, we're going to look at the same example. It makes it easier, right? So we have a forklift that's $24,000, estimated useful life of 5 years. Residual value doesn't matter right now in book value. It will matter at the end, but we don't use it in our calculations. So step 1, we calculate the straight line percentage. 100% divided by useful life, 100% divided by 5. So our straight line percentage is 20%. Step 2, we multiply that by 2. Okay. So our rate of depreciation is going to be 40%. Step 3, we calculate depreciation. We take the book value times the double declining balance rate. Well, in year 1, our book value, we haven't depreciated it at all. It's just the cost. So in year 1, you're going to take your cost of $24,000 times 40% and get a pretty big amount of depreciation. Year 2, it's still 40%, but you're taking book value times 40%. So when you get to year 2, your book value is now 19, well, that's not correct for this. We'll just, whatever your new book value is, you'd have to take what's 40% of 24,000? Well, it 9,600, right? So we'll just correct this. That makes sense. So we depreciated this asset 9,600 in year one. So what's 24,000 minus 9,600? 14,400. Okay. So this is our book value coming into year two. So year two, our book value is 14,400. So when we come to the end of year two, we're going to take book value times 40% to calculate year two's depreciation. So year two, we would take another 40% and get a new depreciation expense.
So we're supposed to end the same 40%
Mm-hmm.
every year.
Yes, yeah, your 40% stays the same, but your book value changes every year. And then again, your debit and credit accounts stay the same. You're just getting a different amount. And here it's showing the depreciation schedule based on double declining. So, you know, in year two, we have a new book value of 14,400 times 40%. So depreciation for that year is 5,760. We subtract that off of the 14,400. So it has a new book value of 8,640. And then you just do it again and again. The only part that gets tricky with double declining is notice in year 5 it took out the rate. Well, what we do at the end here, in year 4, we see our book value is 3,110.4. Well, we can't ever depreciate an asset beyond its depreciable cost. Okay, so it should have a residual value of 2,000 when we're done with it, right? That was its residual value. So to get that last year of depreciation, we just take the 3110.4 minus 2,000. So that way we're not depreciating it beyond that residual value. So that's when double declining gets a little tricky, because that last year is usually where, you know, if you took 3110.4 times 40%, you don't get the 11, you don't get the same amount. What would you get? 3110.4 times 0.4. Because if you just use the 40%, you would be depreciating at $1,244.16. That would be the 40% calculation. But that doesn't work, because then it would put us below an ending book value of 2,000. And again, we'll practice these on Thursday, so.
So at the end of the year that it gives you, you always just take the previous year's book value and subtract it by their estimated residual. Was that 2,000? Yeah.
Yes, yeah, that 2,000 is your residual. Well, just at the end there.
Yeah.
Yeah, just in your final year.
So there could be like a 10-year lifespan, and we'll just take the 90-year minus book value minus the residual estimated residual.
Yeah. Technically, we might have to do it earlier than year 10, but we won't get into that in here. So we won't make it that tricky. So yes, your last year. No. That's like intermediate accounting. Yes.
How does this work if, like, for instance, like a car or something that's always changing book value every year?
Well, our book value will be this our book value is always cost minus accumulated depreciation. So when we're depreciating, we're only worried about what's on our books. We're not worried about the actual market value at all. Yeah, good question. Yeah. Any other questions?